Chapter 10, Cash and Financial Investments. Most companies have at least two checking accounts, one for the general expenses of the business and a payroll account used for just paying the employees. A petty cash fund is used to pay for small items and is maintained on an imprest basis. Imprest just means that a fixed cash fund set aside for minor expenses, that when the account becomes low, it is replenished as necessary. In addition, the company may have savings accounts. Cash includes cash equivalents such as money market funds, certificates of deposit, savings certificates, and other similar types of deposits. Any items that cannot be converted to cash on short notice should be classified as an investment. This slide shows the objectives for the audit of cash. First, the auditor uses their understanding of the client and its environment to consider inherent risk, including fraud risk, related to cash. Second, the auditor obtains an understanding of internal control over cash. Last, the auditor will assess the risk of material misstatement and design tests of controls and substantive procedures as shown. We will discuss the substantive procedures in more detail in later slides. The consideration of materiality applies to audit work on cash as well as to other aspects of the audit. However, due to the nature of cash, a larger proportion of audit hours are spent on cash than might be suggested by the relatively small amount of cash shown on the balance sheet. One reason is that liabilities, revenue, expense, and most other assets flow through the cash account. An examination of the cash transactions helps to substantiate many other items in the financial statements. Another reason is that cash is highly liquid, and as such there is greater temptation for theft, embezzlement, and misappropriation. With any high-risk account, the auditor will determine the risk of fraud and whether the detection is relevant to the overall fairness of the financial statements. Most of the processes relating to cash handling are the responsibility of the finance department under the direction of the treasurer. The finance and accounting department will work together to provide assurance that all cash that should have been received was in fact received, recorded accurately, and deposited promptly. Also, cash disbursements should be shown to have been made for authorized purposes only and have been properly recorded, and that cash balances are maintained at adequate but not excessive levels by forecasting expected cash receipts and payments related to normal operations. A detailed study of the business processes of the client is necessary in developing the most efficient control procedures, but there are some general guidelines for good cash handling in all types of businesses as shown in this slide and the next. The importance of separating the duties of custody, record keeping, and authorization are extremely important in the handling of cash, and proper segregation of these duties is of utmost concern to the auditors as they study the client's controls over cash, as we will see in future slides. Monitoring activities such as using data analytics software can greatly enhance the company's ability to monitor their cash receipts and disbursements. Control over cash sales is strongest when two or more employees, usually a sales clerk and a cashier, participate in each transaction with a customer. This separation of responsibility for the transaction is an effective means of preventing fraud. If it is not possible to separate the functions, a cash register may be helpful or an electronic point of sale system because information is provided to the customer on the transaction visually and by receipt, which can prevent theft. The collection of receivables from credit customer involves many controls, including making an initial list of all cash receipts. Custody and deposit of the receipts and maintenance of the accounting records should be separated. Reconciliation of subsidiary customer accounts to the control account and the mailing of monthly statements can detect errors and sometimes fraud. Collection activity in past due accounts should be reviewed to detect possible fraud. And last, if possible, direct deposit of funds into the company's bank account reduces paper flow and increases internal control. This diagram is used to show the division of responsibilities, sequence of procedures, and controls over cash sales and collections from customers. This description shows how payments are received both from cash and credit sales and how they are processed from the customer through the sales, mailroom, and cashier departments to the bank. The documents, cash receipts or remittance advices, are processed through the mailroom, cashier, and accounts receivable departments. The data entry documents are processed through the data processing and operations control for verification with the bank statement received from the bank. Ideally, cash disbursements should be mailed by check, electronic funds transfer, or for minor items from petty cash funds. Segregation of duties between the accounting and finance departments and payment by check are important internal controls. Pre-numbered checks are essential to internal control. All numbers in the series should be accounted for, and voided checks should be defaced and filed in the regular sequence of paid checks. Security of check amounts by printing on computer or by check protecting machines is important. Purchase orders, receiving documents, and invoices should be matched to show that only valid invoices for authorized items actually received were paid. All documents should then be canceled to prevent paying the invoice twice. The authorized checks should be signed and mailed by the signer of the checks. Monthly bank reconciliations should be prepared by someone who does not have custody of cash. This diagram shows the operation of a voucher system for cash disbursements. Purchase orders, receiving reports, and vendor invoices are matched to check clerical accuracy before the voucher is approved. The approved vouchers and supporting documents are entered into the computer in batches. The purchases, vouchers payable, and cash disbursements files are updated and computer-generated checks are printed. The approved vouchers and unsigned checks are sent to finance for review and signing of checks and cancellation of supporting documents. The signed checks are then mailed to payees and the perforated support is filed. The first steps of the audit of cash involves using an understanding of the client and its environment to consider inherent risk, including fraud risk related to cash. Next, the auditor needs to obtain an understanding of internal control, which we have discussed in the previous slides. Then the auditor should assess the risk of material misstatement and design further audit procedures. After completing the first steps, the auditor will perform tests of controls to determine if they will rely on the internal controls or not in performing the substantive procedures portion of the audit. Examples of some of the tests of internal controls include testing the accounting records and reconciliations by reperformance, comparing details of a sample of cash receipts listings to the cash receipts journal, accounts receivable postings and authenticated deposit slips, and comparing details of a sample of recorded disbursements in the cash payments journal to accounts payable postings, purchase orders, receiving reports, invoices, and paid checks. If necessary, the auditor may revise the risk of material misstatement based on the results of test of controls. The auditor will then perform the substantive procedures for cash transactions and balances as shown on this slide. The auditors seek external evidence directly from the financial institutions to increase the reliability of the evidence for the cash account. Cut-off bank statements can be used to verify the year-end bank reconciliation, and a bank transfer schedule will also be discussed in a future slide, is used to determine if there are any fraudulent schemes being used to conceal cash shortages. The auditor will conclude the cash audit by verifying that related party transactions, if they exist, are disclosed properly in the financial statements. This chart lists the objectives of major substantive procedures for cash transactions and balances with the primary audit objectives or management assertions. One of the objectives of the auditor's work on cash is to substantiate the existence of the amount of cash shown on the balance sheet. A direct approach to this objective is to confirm amounts on deposit and obtain or prepare reconciliations between bank statements and the accounting records. The standard confirmation form agreed to by the AICPA, the American Bankers Association, and the Bank Administration Institute addresses only the client's deposits and loan balances. In more and more cases, auditors confirm balances with financial statements electronically using a clearinghouse approach. This is an example of a standard form to confirm account balance information with financial institutions. Information identifying accounts and loans and their balances is normally included on the form to assist the financial institution in completing it. The form is used to corroborate the existence of recorded information. However, the confirmation may also lead to the discovery of additional accounts or loans, and therefore it provides limited evidence about the completeness of recorded amounts. The bank reconciliation audit procedures begin with the verification that the balance per bank is correct per the direct confirmation with the bank. The reconciliation items should also be investigated by the auditor, including any outstanding checks for long periods of time. Clearing of outstanding checks and deposits in transit from the bank reconciliation can be traced to either a cut-off bank statement or the bank statement for the following month. Other reconciliation items, such as bank charges, should be traced to the journal entries made on the client's books. When internal control over the recording of cash receipts and disbursements is considered weak, the auditors may use additional reconciliation procedures. For example, a proof of cash may be prepared, which, in addition to reconciling the account balance, reconciles cash transactions occurring during a specified period. Especially, the technique is used to identify cash receipts and disbursements recorded in the accounting records but not on the bank statement. Cash deposits and disbursements recorded on the bank statement but not in the accounting records. Cash receipts and disbursements recorded at different amounts by the bank than in the accounting records. This is an example of a proof of cash. The working paper is organized so that the first and last columns reconcile the cash balance per bank and the balance per accounting records, and the beginning of the test period, column 1, and the end of the test period, column 4. These outside columns are equivalent to typical monthly bank reconciliations. The two middle columns reconcile the bank's records of deposits with the client's records of cash receipts in column 2 and the bank's record of paid checks with the client's record of cash disbursements in column 3. The amounts per bank statement are taken from the September 30th bank statement. The subsequent rows of deposits, checks, and other items are taken from the August and September bank reconciliations, and the amounts per books are taken from the client's cash general ledger account and cash receipts and disbursements journals. Many businesses maintain checking accounts with a number of banks and often find it necessary to transfer funds from one bank to another. Historically, checks would take days to clear the bank, and companies and individuals would take advantage of the delay in presenting the check, which was called the float period. Kiting refers to manipulations that utilize temporary overstated bank balances to conceal cash shortages or meet short-term cash needs. Kiting schemes based on the float period became much more difficult after the passage of the Check 21 Act that allows for checks to be processed electronically. However, kiting schemes involving the recording of transfers in different financial periods on the books and when recorded by the bank do still exist and can best be detected through a bank transfer schedule, which we will look at next. This slide shows a bank transfer schedule that can be used to detect kiting. The following rules can be used for determining when it is likely that a cash transfer has misstated the cash balance. 1. The dates of recording the transfer per books from the cash disbursements and cash receipts journals are from different financial periods, such as shown with check number 6006. Or 2, the date the check was recorded by the bank, either the disbursement or the receipt, but not both, is from the financial statement period prior to when it was recorded on the books, as is shown in check number 6029. Check number 5897 does not result in an overstatement of cash per books, but is an example of using the float to increase the balance in the payroll account while simultaneously having the money in the general account. As we said previously, this occurs rarely now due to the Check 21 Act. The Check 21 Act that we discussed previously allows for the presentation of checks electronically with an electronic image called a substitute check. This presentation method has audit implications. There is now a need to rely on substitute checks for evidence of the check, and it is now virtually impossible to kite checks to conceal cash shortages based simply on the float period. Data analytics is helpful because it allows for more efficiency in performing audit procedures for cash, but it also allows for the examination of 100% of the transactions or entries in journals and ledgers using criteria specified by auditors. This slide shows some of the many ways that data analytics can be used to help discover misstatements and possible fraud involving the cash account. The most important group of financial investments from the viewpoint of the auditors consist of marketable stocks and bonds because they are found more frequently and usually are of greater dollar value than other kinds of investment holdings. Other types of investments often encountered include commercial paper issued by corporations, mortgages and trust deeds, and the cash surrender value of life insurance policies for key officers. The auditor should also be concerned with derivatives that are used to hedge various financial and operational risk or for speculation. The audit of financial investments can be very complex, requiring specialized skill or knowledge in performing audit tasks that involve service organizations and information systems technology for derivative transactions necessary to properly value and control these complex transactions, whether they are for speculation or for hedging activities. The objectives for the examination of financial investments include using the understanding of the client and its environment to assess inherent risk, including fraud risk. Next, the auditor obtains an understanding of internal control over financial investments and assesses the risk of material misstatement of financial investments and designs further audit procedures, including test of controls and substantive procedures as listed. Notice that these procedures are tied to the financial statement assertions. Control over financial investments includes the establishment of formal investment policies. An investment committee of the board of directors that authorizes and reviews financial investment activities for compliance with investment policies. Separation of duties between the executive authorizing purchases and sales of securities and derivative instruments, the custodian of the securities, and the person maintaining the records of investments. Complete detailed records of all securities and derivative instruments owned and the related provisions and terms. Registration of securities in the name of the company. Periodic physical inspection of securities on hand by an internal auditor or an official having no responsibility for the authorization, custody, or record keeping of the investments. Determination of appropriate accounting for complex financial instruments by competent personnel. The audit of financial investments begins, as do all of the audit programs, with an understanding of the client and its environment to consider inherent risk, including fraud risk related to financial statements, obtaining an understanding of internal control over financial investments, and assessing the risk of material misstatement and designing further audit procedures. The fact that securities are often very liquid significantly increases the risk of fraud, including theft. In addition, the accounting for financial investments can be very complex, increasing the risk that the investments will not be valued appropriately. If client personnel engage in speculation, they may be motivated to use various improper techniques to hide or delay reporting losses. The use of derivatives almost always increases the risk of material misstatement of the financial statements. In assessing the risk of material misstatement, the auditors will consider these inherent risks in combination with the control risk identified by the auditor's understanding of the client and its environment and test of controls over investments. The auditor will perform tests of controls, including tracing several transactions for purchases and sales of investments through the accounting system, reviewing and testing reports of investment activity prepared for the investment committee, inspecting reports by internal auditors regarding their periodic inspection and review of securities and derivative instruments, inspecting monthly reports on securities owned, purchased, and sold, and amounts of revenue earned and budgeted. If necessary, the auditors will revise the risk of material misstatement based on the test of controls. Substantive procedures that the auditor will perform include obtaining or preparing analysis of the investment accounts and related revenue, gain and loss accounts, and reconciling them to the general ledger. The auditor will inspect securities on hand and review agreements underlying derivatives, confirm securities and derivative instruments with holders and counterparties, vouch selected purchases and sales of financial investments during the year, and verify the client's cutoff of investment transactions, and review investment committee minutes and reports. Further substantive procedures for investments also include performing analytical procedures, making independent computations of revenue from securities, inspecting documentation of management's intent to classify derivative transactions as hedging activities, testing the valuation of financial investments, and evaluating the method of accounting for investments, and evaluating financial statement presentation and disclosure of financial investments. As part of substantive procedures, the auditor will need to test the valuation of derivatives. Accounting for derivative instruments is guided by FASB ASC 815 and FASB ASC 825. Under FASB ASC 815, all derivative instruments are valued at their fair values, but the unrealized gains or losses are accounted for differently depending on whether or not the instruments are classified as hedges. Unrealized gains or losses on the effective portions of hedges of recorded assets or liabilities are offset by related increases and decreases in the hedged assets or liabilities. Unrealized gains or losses on the effective portions of hedges of future transactions are recorded as part of other comprehensive income in the client's financial statements. Such gains or losses become adjustments to the recording of the hedged transactions when they occur. Finally, under FASB ASC 815, unrealized gains or losses on the ineffective portions of hedged derivatives and non-hedged derivatives are recorded as part of net earnings in the client's financial statements. As is the case with other securities, FASB ASC 825 allows an option to companies to choose to use fair value accounting rather than the approach outlined in FASB ASC 815. The fair value of securities and derivatives in many situations may be obtained by reference to sales prices on organized exchanges, which is called Level 1 valuation. If there is no active market for the instruments, fair value may be deduced from active markets for similar investments, which is called Level 2 valuation. However, to use prices from similar markets, the auditors should consider whether adjustments are needed for differences between the instruments being traded in the markets and the instrument being valued. Finally, if no active market is available to value the security or derivative, management may have to use a valuation model called Level 3 valuation, such as using Black-Scholes option pricing model. When the fair value of a financial instrument must be determined using a valuation model, the auditors can either obtain audit evidence to support the estimate by auditing management's process for developing the model, develop their own independent estimate of the value, or evaluate audit evidence from events and transactions occurring after the measurement date. Most auditors use the first approach. To evaluate management's model to determine if it is within the requirements of the applicable financial reporting framework, the auditors will first determine that the model considers all aspects of risk, that all data used in the model was both relevant and reliable, and consider the reasonableness of the significant assumptions made by management. In some cases, the client may engage the services of a specialist to assist in valuing a financial instrument. Auditors must consider the professional qualifications and reputation of the specialist and obtain an understanding of the methods and assumptions used. And this is the end of the presentation for Chapter 10.